Hi, I'm Roger Montgomery from Montgomery Investment Management, and welcome to this week's Video Insight. In November and December last year, I wrote several optimistic articles about possible equity returns in 23. In a December 22 article entitled Why 23 Could Be a Good Year for Investors, I noted poor return years are rarely followed by equally poor years, and indeed are frequently followed by exceptionally good years. I also noted that poor years tend to exist in isolation rather than clustering. In January this year, I pointed to the compression in PE ratios and the double-digit earnings growth expected for many high-quality companies. And in early March, I pointed to the risk of believing a US recession is a foregone conclusion. Well, we're a quarter of the way through our year, and so far it's turned out okay. Equities and bonds initially rallied through January amid optimism surrounding a halt to rate rises by global central banks, which of course immediately generated expectations of rate cuts later in the year. Those expectations, I believe, are entirely misplaced. Then, in February, robust US economic data sunk those hopes. March then witnessed the collapse of several large regional US banks and the merger of failed Swiss bank Credit Suisse with UBS, ending Credit Suisse's 166-year history as a standalone bank. The events prompted fears of global financial contagion, causing equities and bonds to reverse their earlier gains. But by the end of March, level heads prevailed. The fears eased and investors returned to expecting the US Federal Reserve would cut rates by the end of the year, thanks in no small part to the Fed hinting the pace of rate rises might slow. Despite the turbulence, the S&P 500 has gained 7% this quarter. The Nasdaq Composite has risen almost 17%, and the Dow Jones has eked out a break-even of about 0.4%. After their worst year ever in 2022, US 10-year bonds opened the year at 3.88% and ended the quarter at 3.54%. And the Bloomberg US Aggregate Bond Index has gained 2.5% for the quarter. So it's all looking pretty good for the first quarter. The quarter was also marked by a clear increase in the adoption of risk. Bitcoin soared 71% in the March quarter, rising from $16,500 to just over $28,000. Its stablemate, Ethereum, rose 52% to $1,800 from just under $1,200. In Australia, the S&P 200 Total Return Index rose 3.4% and the Small Ords was up just under 1%. All eyes are on the short and long-term plausible paths for monetary policy. While accelerating disinflation is cause for optimism, it's important to realise that the performance of Bitcoin in the quarter and the stabilising of house prices domestically mean animal spirits are still alive and well. And that means central banks will be loath to give the market too much optimism, which is why I think rates could continue to rise. And if they're paused, they may just stay at an elevated level for longer than you think. So investors should remember central banks will be data-driven and they will want to avoid markets getting too excited. If they do get too excited, central banks will have to be more involved. I remain optimistic for investing in high-quality businesses generating double-digit earnings growth. These are the sorts of businesses our small cap team and our partners including Poland, Aura and Australian Eagle are investing in or financing, and they're the businesses I believe you should be doing likewise with. That's all we've got time for today. Keep following us on Facebook and Twitter.